Hey, what's going on, PFR Nation? This is Kevin Lau, your host of the Planning for Retirement podcast, and welcome to another Whiteboard Fireside Chat. We're going to continue this tax theme probably this week and next week, because next week we've got our episode, our big episode, the one you've all been waiting for, Trump versus Harris tax policies and how they're going to impact you, PFR Nation. So if you are not subscribed already to the channel, make sure to do that, because you're not going to want to miss next Thursday's episode. We just did a Whiteboard Fireside Chat on the tax brackets for 2025. So I figured I'd follow that up with the IRMAA brackets for 2025. So yes, IRMAA, everyone's favorite tax boogeyman in retirement. And IRMAA, for those of you that don't know, I've got it on the whiteboard right here, stands for Income Related Monthly Adjustment Amount. This applies to those individuals that are on Medicare. Okay, so if you are on Medicare and you make above a certain income threshold, or I should say income thresholds, you will pay an additional premium for Medicare Part B and Part D. Part A, most likely for all of you PFR Nation, is going to be free. You've been paying into that. That's paid for already. But Part B, you have a baseline premium, and then you might have an additional surcharge, or this IRMAA surcharge on top of that for both Part B and Part D for your prescription plan. So I'm going to break down how this works and also how they calculate the IRMAA calculations based, again, on these 2025 limits. So why don't we jump into this without further ado? Okay, so here are the updated brackets, or the premium ranges, I should call them. That's probably a better term. The premium ranges for those of you who are single. And this right here is for married filing jointly. Okay, and this right here is the premium for B, or the surcharge for B, and this right here is the surcharge for Part D. Okay, so as you can see, if you are single and you make less than or equal to $106,000, it's not your taxable income. It's not your adjusted gross income. It's your modified adjusted gross income. Okay, and like we just broke this down in the last Whiteboard Fireside Chat, the different terms that you want to look for: taxable income, adjusted gross income, effective tax rate, average tax rate. So go back and look at that video if you missed that. But this is a new one. This is called modified adjusted gross income, and it specifically applies to this IRMAA calculation. So if your modified adjusted gross income is less than 106 and you're single, you don't pay any excess premium for B or for D. If you're married filing jointly, it's less than or equal to 212. All right, modified adjusted gross income. So if you're under those thresholds, you will not pay any surcharge for Part B and Part D. I just pulled up the numbers here on this one. Let me get them out. So for 2025, the base premium for Part B is $185 per month. And for Part D, it is going to be based on your plan. So there's a lot of different plans out there, but the average base rate, I should say, the national average is $55 per month. Okay, but again, it depends on your plan, your prescriptions, and all that good stuff. So these are the amounts this is the baseline, and if you don't have any IRMAA surcharge, this is what you'll pay. If you have an IRMAA surcharge, this is the additional amount you will pay on a monthly basis. Let's say you're in this first tier, and let's say your modified adjusted gross income is between 106 but less than or equal to 133,000, and if you're married filing jointly, if it's greater than 212 but less than or equal to 265, this is your surcharge here. So let's call that about 84-ish per month, which is right around $1,000 per year. This is per person. So if you're married, multiply that by 2. Okay, so you can see this kind of adds up a little bit. This becomes almost like an additional tax, if you will. If you're making $100,000 and you're taxed at another $2,000 per year per couple, that's like another 2% tax on top of what you're already paying in taxes. So you can see these start to add up here. Let's look at the next one. Above 133 as a single, up to or equal then 166, again, in terms of modified adjusted gross income, or if you're married filing jointly, greater than 265, less than or equal to 332. Now look at this surcharge. Now we've got 180 plus 34. That's what, 210. We're talking about 2,500 bucks per year per person. Starting to add up a little bit. Let's go down here. The next band, 166 or greater than 166, or up to or equal to 199 as a single. And then for married filing jointly, we've got greater than 332,000, but less than or equal to 398. Look at this surcharge here. Now an extra 288 bucks a month plus another 55 for Part B. I'm sorry, for Part D. So now we're looking at, I don't know, let's call that 340-ish. Okay, now we're talking almost $4,000 a year per person. Okay, and we're going to continue, this continues on, and I'm actually going to focus in on these two brackets here today in this example. I'm going to break down with a client, but you kind of get the gist here. You can understand why people are so up in arms about IRMAA. Okay, but now here's the thing. If you go from no surcharge to this one, and the reason was legitimate. Maybe you were doing some Roth conversions, and you wanted to hit a certain tax bracket in order to optimize your long-term retirement plan. Yeah, that's not a bad thing. Okay, but if you were being willy-nilly and not really paying attention to the numbers, and then all of a sudden you crossed over this next threshold when you could have stayed in no surcharge land, that's where you want to do the tax planning. That's where you want to crunch some numbers, run some simulations in terms of, hey, if my taxable income is this, how might that impact not only my tax brackets, but also IRMAA, income-related monthly adjustment amounts. And what I'll point out is these are the premium amounts for 2025, okay? But it's based on the tax return for the 2 years prior to. So for tax return of 2023. I always need to apologize for my handwriting because it's not good, and I apologize for that. But here's the thing. Just know that it's one of those things that looks backwards. So if you're 63 right now and you're gonna be enrolling in Medicare at 65, that's gonna be the first year you need to pay attention to your modified adjusted gross income. And we're gonna break down this example here in just a second. Now, I will say there are some exceptions you can file for. There are certain qualifying life events like retirement or the death of a spouse or a divorce to where your income went down drastically. Let's say from 23 to 2025, you could file, you can send that exception in to the IRS and potentially get the IRMAA surcharge waived. So just kind of know and keep that in your back pocket. But if there's no other good reason other than your income is high and in that surcharge land, there's really nothing you can do other than think through, how do I mitigate this throughout my retirement? Because it's an annual renewable thing. Just because you're in IRMAA land in 1 year, let's say in 65, you're age 65 or 66, doesn't mean you're going to be there forever. If you can get your modified adjusted gross income down, that's how you can plan for those IRMAA surcharges over time. So what is modified adjusted gross income? How does this work? All right. So very simply put, modified adjusted gross income is AGI plus, there are some things here like foreign income, but the most common one is going to be tax exempt income. Okay. So that's like income from municipal bonds. Many people, if you're in the higher income tax brackets, will invest in a brokerage account inside of municipal bonds or into municipal bonds in order to have them exempt from federal income taxes. And then if you invest in your own state's municipal bonds, they could also be exempt from state income taxes. So many people try to play that game. So what they try to say is, you know what? We're going to nix that. We're going to add that back to the calculation. So let me get out this client example here. All right, so let's make this a different color. So I'm going to break down the different income we have that's going to be included inside of the AGI. So we've got interest income, and that equals $22,501. We've got total dividends. So this is dividends on those brokerage account assets, and those total in the amount of 3,346. We've got IRA distributions, 60,000 and some change. We've got pension. They're both military, so they have nice, healthy pensions. And that amount is 103,580. And taxable Social Security. This is a big one. So your gross Social Security versus taxable Social Security. For them, they are maxed out in terms of their taxation on Social Security. So Social Security, anywhere from 0% of that amount up to 85% of that amount would be included in your taxable income. For this calculation, it's not the gross amount, it's just the taxable amount of Social Security. And that'll show up on your tax return. But this amount is about $72,269. We're going to subtract out long-term capital loss. Because this was from 2022, 2023 in that range where we had a lot of volatility in the market. We did a ton of tax loss harvesting for clients, and we did that for them as well. So that helped offset most of their capital gains, and they actually had a net capital loss in the amount of $3,000 that they can reduce on their adjusted gross income. So if we add all those numbers up, that gives us 259,166, if I did that math correctly. All right. But now we need to add back on tax exempt interest. And that amount was for them 2,813. So we didn't invest in a lot of tax exempt bonds, but we had a little bit in there. So 2,813. So that brings them to their magi. Oops, that is a terrible looking magi. Let me erase that. Terrible looking magi. So their magi equals 261,979. 261,979. So obviously the simple way to do this is look at your tax return, look at your adjusted gross income, and then just add back the tax exempt interest if you had any, and then you'll get to this magi number. But I wanted to kind of show you this client what the makeup of that total income was. So 261,979. Look at this. Look at this. They're married, filing jointly. Boom, we're right here. That's going to be right up in this one. So yeah, we've got a little bit of a surcharge, but there's not a lot we can do. I don't think we can get their magi below 212 at this point in time. I mean, unless what they did was they took this IRA and they said, you know what, all of a sudden, Kevin, we're super charitably inclined. We want to give to charity. They can donate up to $105,000 of their IRA into charity every year. And this $60,000, by the way, this is their required minimum distribution on those IRAs. So they don't even need this. They're actually taking it and reinvesting it. Just because of their healthy pensions and Social Security, that makes up, almost 180 grand of income. They really don't need their IRA distribution. So they could, in fact, like I said, if they woke up and they said, you know what, Kevin, we're charitably inclined. We want to donate this to charity. We've got some charities that are really important to us. Or Helene, maybe there was some Helene victims that they felt really strongly about that they wanted to support. They could say, you know what, we're going to donate this $60,000 directly to charity via the qualified charitable distribution. Okay, I did a video of this in the Whiteboard Fireside Chat, so go look at that one, qualified charitable distributions. But that would, in effect, reduce their magi. Okay, that would not be included in their modified adjusted gross income. So if you took 60 out of there, boom, now we're at 201. They could potentially get into that lower bracket, but that's really not that. I don't think they're going to do that at this point in time. I really think they're going to just continue to take those IRA distributions and reinvest those. But ultimately, they're going to pay a little bit of a surcharge here in Part B, a little bit for Part D, but not too painful. At least we kept them out of this bracket here. At least we're sort of keeping them in this first IRMAA surcharge land. We're not getting into the second one, because the second one definitely gets a little bit more expensive. But, and again, I never tell people to never let the tax tail wag the dog. Just because you're going to have an IRMAA surcharge, again, just maybe a year, 2 years, 3 years, maybe you're doing some Roth conversions. Maybe you're delaying Social Security, but you're doing aggressive Roth conversions, and that's going to put you into a different IRMAA surcharge bracket. Don't let that tax tail wag the dog, because long term, that might reduce those required minimum distributions in retirement, and also ultimately reduce that magi over a longer period of time than just simply avoiding conversions just to avoid IRMAA in the beginning of retirement. So the retirement is a long game. Just because, let's say, you're 60, 62, 63, it is still a long game, potentially a 25 or 30 year horizon, where you need to play the long tax game, not being short-sighted. So, sometimes we need to deliver this news. Hey, Mr. and Mrs. Client, you're going to be subject to these IRMAA surcharges if we do these Roth conversions. But I think communicating that ahead of time helps to avoid that dreaded surprise, because I've heard those horror stories before where I've had clients, reach out and we go through the process. They send us their tax return and we start talking about taxes, and it's a big pain point for them. They're like, oh my gosh, I fired my advisor because, they made me pay more in, a Medicare premium. So even though the intention potentially could be there, if it's not communicated to the client, it's not a good experience. So again, we're not perfect. Us advisors, we're not perfect either. So sometimes it is on us. We need to be more communicative on this one. But that's why our firm, we do tax planning for clients. We run our clients through software that helps with the tax planning to look at all the thresholds that we need to be aware of for each individual client. And that helps a ton. But I hope you guys found this helpful. And don't be too scared of IRMAA. Again, it's a year-by-year thing. It's something that you can plan for if you play your cards right, especially for you, PFR Nation, that you're in that 50 to 60-year-old range, and you're thinking, hey, how do I optimize my taxes, not only for now, pre-retirement, but also during retirement? Because that's also going to create additional tax planning opportunities when you start taking those required minimum distributions, when you start Social Security, when you look at those qualified charitable distributions. There's so many tax planning opportunities for retirees. So set yourself up in your 50s, in your early 60s to really plan for IRMAA throughout the long term. And if you found this video helpful, thank you so much. Make sure to like it. Make sure to share it with a friend or family member that's in a similar boat as you. And make sure to subscribe to the channel. If you're a PFR Nation kind of guy or gal, you're in that 50 to 60 range. Maybe you just cracked the 7-figure mark in terms of saving and investing for retirement. Or maybe you're approaching mid 7 figures or even approaching 8 figures. I mean, this is the type of individual we typically provide content for. Certainly if you're outside of that age range or if you're outside of those asset thresholds, you could probably still learn something, no question about it. But that's our sweet spot. That's our PFR Nation. And I hope you guys found it helpful. And again, make sure to stay tuned for that podcast episode next Thursday, Trump versus Harris, their tax policies and how they might impact you as you plan for retirement. And until next time, PFR Nation, this is Kevin Lau signing off.